What's up everybody, Nate here, and the housing market in the United States has essentially gone from boom to bust over the last few months. Now, what exactly does this mean? Well, we have been talking a lot about on this channel how the housing bubble has popped in the US. A housing bubble pop means that we're not going to see prices go up nearly as fast as we have over the last couple of years. Inventory can have some time to improve, and we're also going to see home buyer demand come way down from where it was. And while initially it looked like things were just going to slow down in the housing market overall in terms of prices and demand, what we're starting to see right now is conditions that mimic what we saw back during the 2007-2008 housing market crash. In the month of August, we saw home prices actually decrease at their fastest month-over-month rate in over 11 years. We're starting to see more and more buyers actually exit the housing market altogether, and inventory is picking back up. Not only that, but with prices essentially coming down faster than they have in around 15 to 20 years, while many homeowners are losing that household wealth and are starting to become way underwater in their mortgages. Not only that, but some institutions like Goldman Sachs are predicting that prices in the housing market are going to come down nearly 30% within the next year or so. So today I want to kind of take a minute to talk about what exactly is happening in the housing market, what we could potentially see in the future, and how all of this is going to affect our economy and current homeowners and home buyers. So the first thing that we have to talk about in terms of what is happening in the housing market is this big decrease in prices. We are starting to see home prices decrease by around 1 to 3% in some of the biggest markets all throughout the United States. And in August, we actually saw 1 out of every 10 homes decreasing by around 4% or more in price. The median home price for a new or existing home also dropped by around 0.77%. Like I said before, the biggest drop that we have seen in 11 years. So what exactly is going on here? Well, the reason that we're starting to see prices drastically decrease in the United States is linked directly to supply and demand. So if you have very little supply of homes on the market, but you have a whole lot of demand for all of those homes, then the homes that are actually on the market, well, the prices are going to be out of control because you have a ton of people vying to get those particular homes. This is exactly what we saw over the last couple of years. There was a lot of demand in the housing market, but there wasn't a whole lot of people that were willing to put their house on sale. Plus, we didn't have a lot of homes built, and that kind of drove this home builder expansion. And it was pretty easy to see why we had demand over the last couple of years. When the pandemic really started, well, the Federal Reserve decided to drop its benchmark interest rates all the way down to 0%. So what does that mean? Well, that means that millions of people have an access to a mortgage that they didn't before. Now you could save hundreds of dollars on a mortgage, and millions of Americans could qualify for a bigger mortgage because interest rates were super low. This drove millions of people to go out and get a mortgage, and it really made sense to do so because you were going to save a ton of money. Not only that, but you had federal stimulus, and you had a lot of other programs that made it a lot easier for, well, people to go out and get a mortgage. So demand was going way up, and people were starting to sell their homes too, but they weren't selling their homes as fast as, well, demand was rising. That sort of created this housing market bubble, and not only that, you had big corporations and real estate investors buying homes and properties as well. So that drove up the price of homes even more because they were going to flip them or they were going to turn them into an Airbnb, making it so there was even less scarcity on the market, so even less supply and even more demand. That drove the median price up for a home by nearly $100,000 in the United States in just 2 short years. Now in 2022, though, the complete opposite is happening. Because the Federal Reserve is getting really aggressive with its interest rate policies, raising them, well, that sucks a lot of demand out of our economy. Basically, what you have happening in our economy right now is really high inflation, and inflation is bad for everybody. We have definitely seen inflation in the housing market with these home properties that really are defying market fundamentals. They're going up in price, but nothing is really changing about the area. Nothing is really changing about the home. It's strictly on supply and demand, and when you have really high demand and you have really high inflation with all of this money printing and really low interest rates, that is all going to equal inflation in the housing market. The Federal Reserve wants to bring down inflation because the value of our money is going down and the buying power is also decreasing too, so people need a lot more money in order to go out and buy all of the same things that they were before, and that's bad for our economy. As interest rates went lower and as the Federal Reserve printed more and more money, well, that meant meant that people went out and spent a bunch of money, and that caused a lot of inflation because businesses had to charge even more for their products. People had to charge a lot more for their home because there were so many people that wanted one particular property. There were so many bidding wars that were happening on an individual home that sometimes homes were selling for $100,000 plus above asking. And that was all basically designed by the Federal Reserve and the federal government because they didn't really know what was happening with the pandemic. They didn't know how long people were going to be out of work for, so they wanted to encourage people to go out and spend. They wanted to artificially create that demand so that way we didn't go into a really long and terrible recession. Now in 2022, though, our economy has improved and the pandemic has essentially gone in the back seat for a lot of the other problems that we're facing. So now the Federal Reserve has been raising its benchmark interest rates all of this year. Now you're probably thinking, well, the Fed is raising its interest rates, but how exactly does that affect mortgage rates? Well, it kind of indirectly affects them, right? Because the Federal Reserve gives its money to the banks and the banks give their money to you. Banks have to pay a certain rate when they get their money, so they have a certain interest rate that comes along with borrowing their money, and that's the Federal Reserve's interest rate. Then when they give you their money, well, they charge you a certain interest rate as well. So basically, if the Federal Reserve makes it harder for banks and financial institutions to get their money, a bank is going to make it a lot harder for you to use theirs. Because of this, mortgage rates from banks have gone way up. Banks are being a lot more particular on who is borrowing money from them because we are in uncertain financial times and they can't just give out mortgages to anyone and everyone because that could mean a really bad situation like we saw during the 2007 housing market crash. And right now, 90% of individuals are getting 30-year fixed interest rates on their mortgage. And the 30-year fixed interest rate for a mortgage has nearly doubled over the last year or so, from around 3% to well over 6%. That means for the same mortgage that you could have got a year ago, it's now going to cost you hundreds of dollars extra every single month simply because interest rates are a whole lot higher. And like I said, this is all planned out by the Federal Reserve. This is all part of their plan to lower inflation and demand in the housing market, because what actually does raising their interest rates do? Well, it lowers demand because now people can't qualify for a mortgage, and if millions of people can't qualify for a mortgage, then those houses on the market are just going to sit on the market until somebody comes along and buys that property. The problem that we're running into, though, is the Federal Reserve may have gone a little too aggressive with its interest rate policy so far, and now more and more people are unable to qualify for a mortgage. They simply can't afford the monthly payments, so the bank isn't going to give them a mortgage. As demand comes down in the housing market, well, there's still people in the United States that want to sell their home, and they need to sell their home because of the financial times, or they want to downsize, or they just can't afford their home anymore. So these are people that are trying to sell their home, but there just isn't any buyers out there to actually purchase it because, well, housing prices are still way too high and mortgage interest rates are too high as well. So one of those things has to come down to bring more buyers into the market, and the Federal Reserve has made it clear that they are going to continue to raise their interest rates. So the interest rates are just going to go up. So buyers have to save money on the actual price of the home, and that is what we're starting to see drop in 2022. Like I said before, this is a real tipping point in the housing market right now because what we're starting to see is a similar situation and similar climate to what happened during the 2007-2008 housing market crash. The first and foremost and biggest thing that we're seeing is a lot of buyers actually go around this 30-year fixed mortgage rate and go for an adjustable rate mortgage. An adjustable rate mortgage is exactly what it sounds like. The interest rate adjusts over time depending on what interest rates are and what the housing market looks like in 5 or 10 years. Typically, these rates are lower, so they're more attractive to buyers because they're not having to pay that really high interest rate. But it can be really scary because you might be able to get an interest rate lower right now, say around 4 or 5%, but if things go up in the future and they go way up in 5 years, well, now you might be stuck with an interest rate that is double or maybe even triple today's rate. Meaning you're going to have to pay hundreds if not thousands of dollars more on your mortgage, and millions of Americans simply cannot afford that. That is what happened during the 2007 housing market crash. People were getting these adjustable rate interest rates because they were saving a ton of money up front, but when things really changed in our economy, they had to pay a whole lot more. I will say this isn't as big of an issue as we saw during the 2007 crash, but adjustable rate mortgages are on the uptick right now, so it's definitely something to keep in mind that could potentially crash things in the future. One of the biggest biggest reasons why we've been talking about the housing market and why we can't see a housing market crash in 2022 or in 2023 is because prices have basically exploded over the last couple of years. What didn't happen in 2007 was millions of people bought a home and, well, the housing market essentially tanked, and that left millions of people underwater on their mortgages. So if they were to sell that home, they would not get nearly enough to pay off the mortgage, so they weren't able to sell at all. That caused a foreclosure crisis because people couldn't sell their home, but they also couldn't afford to live in their home either, so the bank basically took it back. When the bank takes back your home, though, they try to sell it for whatever they can, leading to really, really low prices in the housing market. Housing market prices during that time essentially dropped by 90 to, well, almost 100%. You were basically getting homes for free during 2007. Right now, though, we've been talking about the housing market and how that can't happen because home prices have gone way up. If people were in a situation where they could no longer financially afford their home anymore, well, they could always try to sell it, and they would always come out on top because housing prices have gone up like crazy over the last 2 years or so. They wouldn't run into a situation like we saw during 2007 where people weren't able to pay that price. People are still in the housing market buying homes right now, so that really hasn't been an issue. Except for in September of this year, it really did start to be an issue. Home prices are starting to come down, and in your bigger cities and your bigger markets, home prices are dramatically starting to drop, meaning that whatever people paid for their home, they're starting to become underwater on their mortgage. So if they were to sell their home right now, they would not get what they paid for it initially. So they are stuck in their home and they can't sell it. Now, what you can do is kind of ride out this entire situation and possibly refinance your mortgage later on down the road when interest rates go down. That might be 5 years, that might be 10 years, nobody really knows, but you can refinance and then save hundreds of dollars on your mortgage. But selling your home could be a whole lot worse because then you still owe the bank at the end of that sale. If we continue to see this reversal in the housing market, like we see these home prices continue to come down dramatically, well, that means that home values are going to go into the negative compared to where they were back at the beginning of 2020. Homeowners are not going to want to sell their home because they don't want to lose what equity they do have, and they don't want to sell their home for less than what they bought it for. So people are simply not going to sell their home. The big problem is if that situation is coupled by demand continuing to come down and this big inflation problem, well, now the housing market could be in a really bad spot because now you have millions of Americans that have to pay a whole lot more for all goods and services. They no longer can afford their mortgage, and mortgages are going to go up every single year. Now, what you're probably thinking is, well, mortgages can't go up if I have a 30-year fixed interest rate, right? Well, that is definitely true. Your actual mortgage payment is not going to go up, but housing costs will go up over time. You have your basic costs with running a home, like if something breaks, you have to fix it. And of course, you have other costs like your insurance and your taxes. Those are going to go up as the housing market goes up. So you're going to have to pay more for that too. And the fact of the matter is people cannot afford that if inflation continues to rise in the United States. So that could lead us to a foreclosure situation like we saw during 2007. Millions of people unable to afford their mortgage. Meanwhile, they can't sell their home either because, well, there's nobody to buy it. And if somebody was willing to buy it, they're not going to give them enough in order to pay off the rest of their mortgage. And what that leaves us with is a situation where inventory is actually outpacing demand. And when that happens, housing prices are going to go even lower. Now, it's really important to note here that this is all coming down from a really and pretty crazy elevated level, right? So over the last couple of years, the housing market has basically exploded like it never has before. We've seen demand go way up, we've seen supply go way down, and we've seen prices go way through the roof pretty much uncontrollably. Now, with the housing market coming down, it needs to kind of come down to reach a normal point again. Home affordability is basically zero in the United States right now, which means that houses are way too pricey for the average American. And well, what is the true value of a home? If somebody's not willing to pay a specific price for it, then that home is not valued at what the seller wants to sell it for. If a seller says they want to sell a home for $100,000, but nobody is willing to pay that price, then that home is not worth that. If somebody comes in and buys it at $80,000, then that is the true value of the home. We need to see that equilibrium in the housing market sometime soon in order for things to get back to normal. And that is where we're headed right now. We're starting to see see demand come way down and we're starting to see supply come way back up, meaning that prices are starting to come down too, and they're starting to come down to a place where more and more buyers will naturally enter the housing market. Now, the housing market is still going to be restricted in the United States for pretty much the foreseeable future because of the Federal Reserve. The fact of the matter is we have no idea how long the Federal Reserve is going to raise their interest rates and how aggressively they're going to be once they're done. They have said that they're going to continue to be aggressive and raise their rates until inflation is going way down in the United States, and right now it shows no sign of stopping. Until those interest rates go way down, well, there's going to be fewer and fewer buyers in the housing market. This is basically a reversal of what we saw over the last 2 years or so because housing prices were really high, right? But mortgage interest rates were very low, so people were still saving hundreds of dollars on their mortgage because those interest rates were really high. Now it's the opposite. Housing prices are starting to come down, but mortgage interest rates are starting to go up. That means that it's all going to balance itself out, but like I said before, this is a tipping point. If we see too much demand come out of the housing market, then inventory is going to outpace demand and prices are going to go way, way lower. People are going to be underwater on their mortgage. They're not going to have any equity in their home, so they can't sell. Now, if inflation ultimately goes down and people make a lot more money, then they'll be able to afford their mortgages and nothing really bad is going to happen widespread throughout the United States. You're going to see foreclosures uptick in the United States, but it's not going to be crazy high like we saw in 2007. All people have to do at that point is just wait it out, because until they actually sell their home, well, then they won't have to worry about the price going up or down. In the meantime, people who want to buy a home are just going to have to be creative. They're going to have to find different areas. They're going to have to find different ways in order to buy homes. We still see some buyers in the housing market, so that's a good sign, but they're starting to get deals. They're starting to not have a lot of those bidding wars because there's not as many people trying to get one single house. They have a little bit more affordability. They have a little bit more control over getting a home right now, and that is a little bit more normal for what we're used to seeing in the housing market, and it's not so much of a seller's market in 2022. So yeah, the housing market is definitely cooling off a lot right now. It's actually starting to cool off a lot more than we even anticipated, but is this going to turn into an outright freeze sometime this winter? Well, we'll just have to wait and see. But now I want to hear from you on this issue. What do you think about the housing market essentially losing a ton of value over the last few months? Do you think this is a sign for things to come, or do you think that the housing market is going to rebound sometime soon? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.